Our session today, Investment Trends 2021 and Beyond, hosted today by IGM Financial in partnership with Coffee. Before we begin today, we always like to start off with a land acknowledgement. So we'd like to do that. So we acknowledge that Coffee, Mackenzie, and IPC's head offices are situated on the traditional territories of the Mississauga of New Credit First Nation, the Anishinaabe, the Haudenosaunee, Wendat, and Huron Indigenous peoples. The Greater Toronto Area is home to many diverse First Nations, Inuit, and Métis people, and we are grateful to have the opportunity to work in this community. We also like to acknowledge that our IG Wealth Management head office is located in Treaty 1 territory, the original lands of the Anishinaabe, Cree, and Dakotas peoples, and homeland to the Métis. I would also like to acknowledge that you are joining us from many places, near and far, and acknowledge the traditional owners of and caretakers of those lands. It's important when we're all joining virtually from different locations across the country. So in terms of our agenda today, so we're going to provide everyone with a brief overview of IGM, as there may be some of you that don't know who we are. So we'd like to have an opportunity to fill you in a little bit about who we are. We're going to learn more about our panelists. We're then going to move into our panel discussion, followed by a Q&A session. So, if you're thinking of any questions throughout the presentation, please feel free to type those into the chat as you think of them, and we will address all of those questions in the latter part of the Q&A discussion. And then afterwards, we're going to have an opportunity to do some networking in the virtual world. So we'll have 3 separate breakout rooms. Breakout room 1 will have members of our Black Advisory Council from IGM, which is our Black Employee Resource Group, as many of you may know of employee resource groups. We then will move into the other breakout room is members of our talent acquisition team. And then finally, we'll have a couple of our panelists today in the third, sorry, that's a typo, the third breakout room. So depending upon your interest, after the session today, you can join whichever breakout room you would like to attend, or you can spend a couple minutes in each one if you wish. So our moderator today, I'd like to introduce you to Gary Chatterum, and Gary is our SVP and co-head of retail distribution on the Mackenzie investment side. Gary will go through our IGM corporate structure, but essentially there's 3 organizations that make up IGM, and Gary is here representing the Mackenzie side of our business. So Gary joined Mackenzie in March 2020. And he's got 13 years of experience in the financial services industry, beginning his career with AIC Limited in 2007. Then he moved on to a role at Fidelity Investments, covering the downtown Toronto IROC advisors. And he was later promoted to an institutional sales role at Fidelity in 2010, where he covered defined benefits and defined contribution pension plans. Gary's extensive experience in financial services is strengthened by his commitment to learning. Gary has achieved 2 undergraduate degrees, one in molecular biology, wow, and another in finance from Concordia University, and a master's in administration from the John Molson School of Business. Gary has both his CIMA and CIM designations, and currently sits on the Canadian Advisory Board of the Investment and Wealth Institute. Gary recently completed the Diversity and Inclusion Certificate from Cornell, and he's also fully bilingual. And fun fact, very important fact, he was voted top 50 under 50 at his alma mater at Concordia University. That's a pretty awesome accomplishment. So at this point, I will pass the baton over to Gary, and he will walk you through some important information about our organization to start things off.
Thank you very much, Janice. It's a pleasure to be here today. I've been attending some of these sessions earlier on when I first moved to Toronto from Montreal. So it's a pleasure to have the opportunity to speak to you today. IGM Financial, we want to give you an overview. It's a leading wealth and asset management company supporting financial advisors and their clients in Canada and institutional investors throughout North America, Europe, and Asia. Now, through its operating companies, IGM provides a broad range of financial planning and investment management services to help Canadians meet their financial goals. So currently, we manage approximately $271 billion in total assets under management and advisement, and the company creates value for its shareholders through three key areas, and you'll see them on the slide. So on the left, wealth management under the brands of IG Wealth and Investment Planning Council. That is where one of our speakers today, Bill, he's from the IG Wealth team. On the right-hand side, you'll see it says asset management. It's under the Mackenzie banner. Mackenzie is an iconic brand in the Canadian asset management industry. That's where I am part of the team. And in the bottom part, it's strategic investments. So areas where we see future growth, where we've decided to partner to build our capabilities. We are an owner of China Asset Management, one of the largest asset management firms in China. Fun fact, 1 in every 50 people in the world are a client of China Asset Management. In the middle, you have Northleaf. Northleaf is a strategic partnership focusing on private markets, so private debt, private infrastructure, and private equity. On the right, you have Wealthsimple. Yes, we are one of the strategic investors in Wealthsimple for anybody that has their online account, either doing their personal trading or trading crypto. And then two names you may not be as familiar with, Portage and Great-West Lifeco. So all in all, these organizations roll up to form IGM Financial, which is one of the leading businesses in Canada in financial services. Now, what we've done as we move to the next slide, advancing diversity, equity, and inclusion is a core focus of the organization. I actually have I'm fortunate enough to be sitting on the executive council for diversity, equity, and inclusion at Mackenzie. It gives us the ability to communicate and get a broader perspective of what happens throughout the organization and set strategic plans to ensure that we're meeting our goals. You'll see at the bottom just some of the organizations that we've actually partnered with. I was here in the early days when we signed the Black North initiatives, but you'll notice that we have other groups. We work at Pride at Work, UN Women, and it's a holistic approach. It's how do we build a culture that makes everyone feel included? It's really gone to the inclusion aspect that we're tending to focus on now, because that's where we believe the magic hits the road. So what we'll do now is I'm gonna move to the next slide and start introducing the panelists, the people that are here joining us today to share our views about trends in the industry. So the first person I'll introduce to you is Bill. A pleasure meeting Bill. Bill is an investment strategist with IG Wealth. He brings over 30 years of experience in global capital markets. Bill is an avid speaker. He speaks all across the circuit on many different topics. Today, you'll hear his views on forecasting. When I met Bill, it was very intriguing to get those perspectives. But Bill has been in this industry dating back now with many years of experiences, both as a stockbroker and a fund manager. So he has different perspectives that he's able to share with the tenure he's had in this business. He's also, as you see there, a CFA, a Chartered Financial Analyst, which is one of the key designations in our industry now, if you're looking to get into the asset management world and specifically strategy portfolio construction side. As we move to the next slide, Hadiza, high five. Hadiza and I share a love for old school music, mainly hip hop. Hadiza works within our investment product team, focusing on fixed income mandates. But fun fact, Hadiza came over from France, where she worked as a portfolio manager at AXA Investment. So bringing tons of skill, fluently bilingual. It's a pleasure to work with Hadiza across Canada, but specifically in Quebec. So I think there may be some people in Quebec on the call, but we have the capacity at Mackenzie. When we talk diversity, we look for all factors of diversity, and language is another area. You'll see at the bottom, I thought I had a lot of education and degrees, and then I met Hadiza, and I said, okay, undergrad in mathematics and computer science, 2 master's degrees, one from the US, MBA from Washington University, and she's fluently bilingual. So it's just a pleasure to have Hadiza here to share her perspectives today. And we're going to end with Barris. Barris was actually part of the sales team, retail sales team, and then he moved on. He saw a brighter future ahead in sustainable investing. And this week coming up, it's COP26. Sustainable investing is all the rage. And Barris is here to really give us the perspective of what's happening in sustainable investments. Where do we see the trends? He has over 20 years of experience in financial services. He has an honors degree, a BA from the University of Toronto, majoring in economics. And it's the beautiful thing is that he has the perspective of being on the sales side and now being in part of one of the key areas of business, leading the growth in an area of the market where it is just phenomenal what's happening, not only at Mackenzie, but industry-wide as we look to solve the climate change initiative. So what we'll do now is, I believe we're going to start off. I'm going to ask a question. I believe, Barris, I'm going to throw the first question over to you to kick off the panel. If you have any questions as we go through, kindly put them in the chat to the right. And what we will do is we will take all the questions at the end of this section of the presentation. So Barris, as we kick it off, I kind of mentioned that sustainable investing has taken off. Which themes have attracted the most interest for sustainable investors over the last 12 to 18 months?
Great starting question, Gary. Thanks very much for the kind introduction. Thank you, everyone, for having us here. I am also an old school hip hop fan. So before I get into my answer, I will state that out loud. But to answer your question specifically, Gary, sustainable products in general have grown exponentially over the time frame that you mentioned. So in Canada, at the end of 2019, we had approximately $12 billion in total AUM for all sustainable products. By the end of 2020, we were at around 20 billion. So that was about 60% growth right there. By the midway point of this year, we were at about 30 billion. So now you're talking about another 50% growth. I just checked a few weeks ago, we were at over 36 billion. So the first number I mentioned was $12 billion. Now we're at 36. We're talking about in a little under 2 years, AUM tripling. The themes that appear to be getting the most interest over that period are products focused on environmental themes. So that's whether we're talking about specific energy plays, renewable energy, clean tech, solar, wind, and others. For a lot of asset managers, you will hear things like climate being mentioned, not only in their products, but also in terms of their promotion. Other things that we'll say for Mackenzie specifically is that we have one of the top selling products in the industry in our Mackenzie Green Chip Global Environmental All Cap product. So that was a shameless plug, but I'll second that with a second shameless plug. It's also the top selling sustainable investment product in Canada over the last 12 months. So great news for us on that front. So that's the last little while. But what about the future? Themes that we think are going to garner more assets, or at the very least start getting more interest from investors, are going to be themes such as social themes. So products focusing on social issues, as that kind of data becomes more widely available, and perhaps more broad-based, best-in-class ESG being utilized as a new core, if you will, as part of investor portfolios. So that might potentially replace more traditional core approaches. And so that would be where we've been and where we think that we're going in the future. Thank you.
Thanks, Barris. So now that we know we have three hip hop heads on the line, Bill, I know I'm not up with you next, but you better come up with a good answer because I see the guitars in the background, and I don't know if we can count on you for this one. Hadiza, as we look out, you hear a lot of talk about inflation. What are the key challenges investors are facing in today's bond market from your perspective?
Thanks, Gary. It is absolutely a fundamental question in the current environment. And also, thank you for the intro. And I'm very happy to be here with old school hip hop fans. Fixed income, before I get to the answer, I want to just kind of level set why fixed income is important as an asset class. Historically, fixed income has been not only acting as a protection when equities are turning. Typically, fixed income tends to rise, the price rising, and somewhat offset the losses that you're facing on the equity side. So it's been an asset class providing you with some form of diversification, stable income, and capital preservation. When you look today, the US 10-year is about 1.5, 1.6%, give or take. Back in the 80s, we have about 13, 14% rates in nominal rates. So we went all the way down from these 10%-ish rate ranges into a range that is now between 1 and 2%. And obviously, investors are asking themselves, how are they going to be able not only to get that protection when you're getting almost to lever zero in terms of those rates, but also how can they get income in that environment? Inflation, in our view, is the most acute risk in the current environment for fixed income holders, because inflation, as you've seen, has been really picking up significantly after the global pandemic. You saw these shutdowns resulting into no activities, and then the reopening going into hyperactivity, supply chain disruptions, who led to those 4% inflation that we're seeing today. So how can you, as an investor, imagine a 4% inflation and have a yield that is about 1.5%, knowing that your real yield is actually negative? So it is an acute problem. There are hopefully some solution into that environment. And one of the solutions is to look at holistically into non-traditional fixed income. And that's some of the things that our team at McKinsey has started really doing even before COVID, really thinking holistically and flexibly around fixed income. And also to mention something important, fixed income covers such a different layer of risk and return profile. We tend to see in silo government bonds, but there's really different type of correlation that you can find within the fixed income landscape. And I'll pause here.
Okay, thanks. Those are good insights because like when we think fixed income, as you said, we started off high, came down low, and with the fear of inflation, a lot of people are trying to figure out where the market's going. So now I'm going to turn to Bill, because Bill, I want to get from your perspective, can you provide us with your forecast on where the markets are heading?
So thanks for having me. And not only am I going to disappoint you in the fact that I am not a hip hop fan, I am a classic rock fan, which might not be surprising given the age. But I can't forecast where the market's going to go. And I would offer that forecasting is of little value to an investor in the, let's call it, short to medium term. It tends to lead to market timing. Is it a good time to be in the market? Is it a bad time to be in the market? And market timing typically leads to very poor, if not disastrous, individual client experiences. So maybe just to solidify that idea, if you would put up the slide that I sent, and I'll just spend a second on this. I call it the fallacy of forecasts. But what you're looking at is data going back to 2002. And each one of those blue bars represents the consensus forecast for the coming year on the S&P 500 starting in January of that year. So we'll just deal with the bar on the far left to give you a sense of what I'm talking about here. That bar on the far left is 2002. In January of 2002, the consensus was that the S&P 500 would go up 14% that year. So a pretty good year. The red dots that you see all over the place is actually what happened. In 2002, it went down 27%. So the forecast wasn't even close. I mean, it's not a gimme putt. It's not inside the leather at all, right? And if you look across that slide, what you see is that those red dots are rarely even close to the blue dots. So in my opinion, the forecast is a distraction. What I would say about this slide that is important to note is that you'll see that at the beginning of every year, that the forecast is for a positive experience every year, right? You have a positive forecast going across that chart for 21 years. And I agree with that because 7 out of 10 times, it's actually more than 70% of the time, you get a positive experience on a calendar year return on the S&P 500 or on the Canadian stock market as well. So you have 70% odds of having a good experience without having to decide, is it a good time to be in the market or a bad time? So my forecast is 7 out of 10 times, I'm going to tell you it's going to be a good year. That's my forecast, Gary.
So when I look at this, it's very telling. So if we can actually forecast and we have that challenge, what is your approach to constructing portfolios for your clients?
Sure. So what we're trying to do is we're trying to measure a client's risk tolerance to a portfolio that represents that over time. Okay, so let's start with the building blocks. We have individual, or I'll call them standalone portfolios that have very, very specific mandates, very specific goals and objectives, right? So let's call it large cap value or international small cap. So those portfolios are actively managed. They're constructed using security selection, right? And diversified within that investable universe that's defined by the mandate. We then take those portfolios and use them as building blocks to create what we call a managed solution. Now, that managed solution will include a broad array of different portfolios that are tailored to construct what I call a bucket of risk. So to match up with an individual's risk tolerance. So for instance, we can define them as a conservative portfolio, an aggressive portfolio, moderate aggressive, through that risk spectrum. So the ideal is to take those building blocks, create the solution, and then the real heavy work is managing or tailoring that solution to the client's risk profile. And this is important, okay? Because this is where the value of advice really comes in. This is where typically an individual investor needs help understanding what is their tolerance for risk, what is their threshold of pain, if you will, that will lead to bad investment outcomes over time. So taking those solutions and tailoring it, to an investor's risk profile is known, with the value of advice embedded in it, is known to provide empirical evidence says that you get a better investor long-term experience, a better investor outcome than you do trying to decide if it's a good time to be in the market or a bad time. So that's the goal.
No, that helps a lot, Bill, because as we know, when you look at this chart, it becomes very difficult to try and forecast the future, and controlling behavior tends to lead to better results over the long term. You don't have to worry about being a classic rockhead. In hip hop, we love to sample, so we'll borrow from anywhere we can to make a hit. So I'll have to find a sample of a classic rock song that we've turned and made into a pop hit. So
perfect.
Stay tuned. Barris, I'll come back to you on sustainable because we can't forecast market returns, but we can forecast demand. So leading up to COP26, what's interesting is Larry Fink, who heads up BlackRock, says he believes the next 1,000 companies that will end up becoming billion-dollar market caps are all going to be in the sustainable space, whether they're green tech, green hydrogen. So the question I have for you is, many asset managers now are launching products in the sustainable investing space because they see the demand coming. What makes Mackenzie different?
Another great question, Gary. Thank you. It's going to be a lot more shameless plugging. But first, what I'll do is I'll answer the other question that you had for Bill. So Jay-Z actually sampled the Doors for the Takeover. So there's that example right there. So, and to answer your question specifically, and to follow up the great answers that have already been given by Hadiza and Bill, I would say if we could summarize our difference in one word, and if I could ask everyone in the audience to just take away one word from the whole time that I talk, it would be authenticity. One of the things that we pride ourselves on the most is the fact that the development of our product shelf was not thrown together haphazardly or by using existing managers and just slapping an ESG label on them, as quite frankly, many of our competitors have done. So we only launched our sustainable boutique and the majority of our shelf in 2017. And now we're approaching $4 billion under management as a firm. We initially started with sub-advisors as we wanted to show our commitment to the space by not simply assigning that task onto one of our existing boutiques. So we launched 2 products in 2017 and both had sub-advisors. One was a balanced fund where we had Rockefeller Asset Management. They manage the equity sleeve, and they're based out of the US, as most of you probably know. The other was our Global Women's Leadership Fund / ETF, which is sub-advised by Impax. And Impax was the folks who launched the first ESG fund ever, and were one of the first asset managers in the world to take a gender lens to sustainable investing. On the balanced fund that I mentioned in 2017, our very own fixed income team, which will be near and dear to Hadiza's heart, was one of the boutiques that we already had in-house that we felt had an extremely strong ESG investing profile. So we've since launched several products with that boutique. They manage the fixed income on all of our balanced products. And so they have both balanced and standalone products now. For the environmental space, we went out and initially hired Greenchip in 2018 as a sub-advisor. Greenchip had been investing solely in the environmental space since about 2007, and they were pioneers in the space. In late 2020, we showed our commitment to the space by acquiring Greenchip, and we made them our first dedicated sustainable investing boutique. Then, in early 2021, we went out and hired another fantastic portfolio manager by the name of Andrew Simpson, which obviously my colleagues on the line are going to be very familiar with. With that, we launched our second dedicated sustainable investing boutique, Better World. All that boutique has done for the past 10 plus years is invest with an ESG focus first. Before it became interesting, before it was a trend, and before it had the attention that it has today. So for all 3 boutiques, and what I would say for our approach at Mackenzie, whether that's fixed income, Greenchip, and Better World, they have not only invested sustainably throughout the years, but they've done so while delivering exceptional performance. So we're very proud of what we have accomplished as a firm so far, but I can honestly say we are only getting started. And I hope that answered that question. Thanks, Gary.
No, that was great, Barris. And when you talk about authenticity, again, we live in a world where it's Twitter, it's Instagram, it's a lot of things for show, but it's great to hear what we're doing. We have this conversation with the client. That is something that we bring to the table that people have taken note. So Hadiza, as we turn to you, I'd like to hear your perspectives. How is Mackenzie now navigating the current environment and actually creating value for its investors?
Thanks for the question, Gary. It is absolutely essential. And I think I'm going to build on what Barris just said, because those are really fantastic proof points of how McKinsey is committed to sustainability, and sustainability is somewhat part of creating value for our clients. If you look at the fixed income team, there's been early adopter of sustainability, and they are really allocating a lot of resources, meaning that we have today amongst the fixed income analysts, people bringing models, proprietary models that are internal, that are really, this is a transition. This is not about the destination, it is a journey. So you need to be able to have those resources in-house to make sure you do your due diligence and you're really striving for creating impact and funding company. And fixed income is a natural space to drive that change, because you have the ability to influence company in the way you're going to fund their projects, green projects, social projects, etc. The fixed income is actually able to influence the company to the point where they will issue a bond that has the sustainable characteristic that we're looking for, meaning that we have that power of reverse inquiry with notably company in Canada. Now, if I look a bit broader how we're creating value, it is around also looking at those non-traditional type of assets. Alternative has been a space where we've been growing significantly, offering differentiated fund, differentiated approach, where the objective is to offer high yield type of return, equity type of return to investor, but also with quality. Private debt is also another space where somewhat you have assets that are decorrelated from typical assets, and no wonder pension funds have been allocating strategically to those building blocks for many, many years. And today, I'm very proud that McKinsey is able to democratize the access to alternative, to private debt, to all those differentiated type of strategy in the form of mutual fund, and have people being able to hold them in their savings, and really benefit of all these benefits.
Thanks, Hadiza. I couldn't agree more. The private asset classes, we see the demand, we see the activity happening in the marketplace, and we all know that it's going to be critical going forward for investors to have access to these asset classes. So, Bill, I'll turn over to you for the last question. What do you think are the critical items that we should all consider to be good investors?
Well, as I mentioned before, I think it's all about getting help, getting advice. Markets are inherently volatile, and I'll talk to this slide in a second. But I think it's, the volatility works on a person's individual psychology in different ways. And, you can walk into a room, grade 6 classroom, and ask somebody, how do you make money in the stock market? And they'll tell you that you buy low and sell high, but we know that nobody does it just by cash flows. So there's this constant dichotomy between what people want to do and what they actually are trying to do and what they end up doing. So I have this slide here, and I say what you do here will ultimately determine your success. And it's a very busy slide. There's a lot of data here. I'll just explain it very quickly. This data goes back to 1980. And once again, what you're looking at, those blue bars are the calendar year return on the S&P 500 going back to 1980. So if we just look at 1980, the far left-hand slide, and I don't know if you can make out the numbers there, but that blue bar says that during calendar year 1980, the S&P 500 finished the year up 26%. So it was a really good year. So what that red dot is what happened during the year. So the drawdown, the inter-year drawdown that year. So let's go and say in January, the market starts going up and up for a couple of months, and it hits some threshold, and then it starts to draw down or sell off a bit. And as I said earlier, everybody has a different threshold of pain, and that's what we're trying to figure out. So the market goes down 5%, 10% maybe, and you start reading headlines that say, GDP wasn't as expected, interest rates are rising, there's a problem here or there. And the news flow becomes very, very negative. And at some point you say, well, how should I respond to this? I have to respond to this information I'm given. So this is fun with math. to be fair and clear, it's fun with math because we can't pick bottoms and tops. But that red dot says that inter-year 1980, the biggest drawdown was at 17%. Okay, so the market's now down 17%. And if on that day, fun with math, you said, okay, I can't take it anymore. I want to maintain what I have left. I can't lose any more money in this endeavor. I have to protect what's left. I'm going to sell. If you sold on that day, it was down 17%, your cost of opportunity is about 40%. Because if you put $1 in on that day, you would have received about a 40% return on that capital. That's how you win. You cannot win, okay, by selling at the bottom and, adjusting the portfolio based on information that may or may not be helpful. So if you look across that slide, once again, there's a lot of data there, but what I would point to is all those red dots. And what that says is that every year, every calendar year without exception, there is a negative return that is achieved. And it's how you respond to that event that will determine ultimately how financially successful you are. So you can see the other thing to note, I mentioned 7 out of 10 times, 70% of the time having a positive experience, you'll notice that those blue bars are probably at least 70% of those bars are positive. So we spend a tremendous amount of time worrying about the 30% of the time that we might have a negative experience, and we respond to it in the wrong way. And that ends up, quite frankly, it ends very, very poorly in terms of our ultimate investment returns. So what is critical? What is critical, I think, is to get advice, to understand your ability to accept risk, because that's the ultimate differentiator. It's not return. We'll all take all the return we can get. But each one of us has a different ability to accept risk based on career, based on lifestyle, based on any number of factors. So we want to know what that is. We want to get a solution that is tailor-made to that risk profile. And then we want to have the focus and the discipline to allow it to work. So that's my story.
Bill, I love this slide. I've never seen this slide. I'll jump back to my institutional days where we got into a lot of these conversations with defined contribution plans. And the feedback I give the audience is, if your company offers any savings vehicle where there's a match, always maximize it. If you put in $100 and they're going to give you 20%, that's an automatic 20% return.
Absolutely.
And what's even more powerful is it tends to take away the risk because you dollar cost average. Yep. You buy on every paycheck. And what it allows you to do is take advantage of these red dots you're seeing on the screen, and it takes away the emotional behavior where you just keep purchasing no matter what's happening in the marketplace. So, Bill, I love this slide. It's very instructive. I'd like to thank everyone on the panel here today. And I think at this time, what we're going to do is we're going to turn it over to the host to see if there's any questions in the chat that we could answer.
Yeah, so we've got some questions coming in, which is great. The first one I think is for you, Barris. So it's coming from Meryl. How does IGM address the challenge of making sure corporate disclosures focus on what matters rather than a laundry list of ESG issues?
That's a great question. Really thoughtful question. Thanks for it, Meryl. So what I would say, Janice, could you just go on mute just so there's no echo? Thank you. Appreciate that. So what I would say with respect to that is that's something that's really important to us as a firm. It's something that we're in the process of figuring out right now in terms of what additional metrics that we need to start reporting on. As Gary mentioned at the top, he is part of our diversity, equity, and inclusion chair group, right? So what that means is like they are responsible for signing up initiatives such as a Black North Initiative. We're also a signatory to women's empowerment principles. We're signatories to a lot of different climate initiatives. So just a few are Climate Action 100 Plus series. There's a bunch of other ones that I can name, but I won't go through all of them. But what we're trying to do with all of that is to be really inclusive, be as inclusive as we possibly can, identifying as many issues as we possibly can as an organization, and then reporting on all of the relevant factors. There are certain ESG factors that we have to report on as a firm, and those are probably the ones that you're likely thinking are like, okay, well, those are the vanilla things that everyone should have. But there's a lot of things that firms don't even have. What we're in the one thing I'll mention right now, and I don't mean to make a super long-winded answer, but what we're doing is we're trying to identify how everyone at the firm identifies. So self-identification, and that's racial background, that is gender backgrounds, all of those kinds of things. We're trying to identify that because the goal is one day that we hope to be able to disclose those things. One of the areas, if you look at various ESG factors, that is really missing out for the broad public, and this is bonds and stocks, there's not a lot of disclosure on those factors. If you try to find out how many Black people are in senior management at firms, that's not an easily decipherable field on Bloomberg. That it just doesn't exist for a lot of corporations right now. So we want to be at the head of some of those metrics, and we're currently working on doing all that. So I hope that answers that question.
Awesome. Thank you, Barris. That's really informative. The next question is coming in from Colin, and this one's for you, Bill. Bill, with your experience in the industry, what has been the most surprising / interesting / shocking event and market reaction that you can recall?
Well, I bear the scars of Black Monday, October 19th, 1987, to this day, when I was a stockbroker. And I went home and I told my wife that there was no more commission dollars in the world, that we will be functionally bankrupt in probably about 34 hours. And I was wrong, fortunately. There's something, it's an interesting question because it's something that I've kind of been playing around with. And if you allow me a second here, I call it the institutional memory. And what I mean by that is that I just mentioned 1987. Well, we had the Asian contagion in 1998. We had the great tech wreck of, call it 1999, 2000, however you want to frame that. We had 2008, 2009, affectionately referred to as the great financial crisis, and we just had the global economic shutdown due to a global pandemic. So there's been any number of these events. But we seem to make, collectively, the same investment mistakes over and over and over. And it became an issue with me to the extent that I tried to figure it out. And I'll give you an example of what I mean. In 1999, the largest stock on the Canadian Stock Exchange was a company called Northern Telecom. It was a 37.5% weight in the index. It made no money. The individual investor was infatuated with it. I actively managed a portfolio at that time that had, because it was dividended out of Bell Canada, I had exposure there and I didn't understand it and I sold the stock. That doesn't make me smart. If the stock was a $500 stock today, you'd be talking to somebody else. But my point is that today there are things in the market that might remind me of Northern Telecom. So I go into our pool of analysts and I say, I don't know much about this, but my memory brings to mind this Northern Telecom. And they look at me like I have a green face. They have no idea what I'm talking about. And I go, Northern Telecom, 1999, the largest stock in Canada. And they look at me and they say, well, 1999, like I was 12, right? So that my point is that the reason why we repeat these mistakes or positives is that we lose institutional memory around every cycle, around every 10 years. So now we have analysts that are building that institutional memory based on, COVID, how to deal with a pandemic, right? March the 20th was very instructive. If we go back to that chart, I don't want you to put it up, but you think about the stock market was down 35% on March the 20th, 2020. And the forecast said, the global economy is shutting down. Everybody's got to go home. Nobody can go to work. We don't know how this thing's going to end. What does that mean for the market? Oh, it's going to zero, right? Like, how can the stock market go up in that? But it did. It's more than doubled off of that bottom. So, but that memory is being created again. So when you ask the question, events like that, there have been many. But what they do is they build into that institutional memory, and the firm captures it, not the individual captures it. So to Barris's point, authenticity at the firm level, we have broad experiences across. We have old guys like me, we have young guys like the analysts I just mentioned, and collectively those experiences are brought into the construction of those portfolios, hopefully to improve ultimately our clients' investment experience. Long-winded answer, sorry, but.
No, Bill, that was awesome. Thank you. We've got a question coming in from Delmar. Delmar, fun fact, is actually the president of Coffee. So thanks for your question, Delmar. We'll throw this out to anyone on the panel. For both the new and old investors, how can we deal with inflation, and what kinds of investment products should we consider?
Janice, I'm happy to take that one, and I think it is an excellent question. And my answer would be in two parts. The first one is you have products that can offer you a direct inflation hedge. Those products will be typically inflation protected security like TIPS in the US. We have a passive ETF named QTIP. Yes, you've heard QTIP. And QTIP is tracking an index that is composed of different maturity on the TIPS curve. So typically when you see the correlation between Canadian inflation and US inflation, it is a good product to seek protection. Now you have different type of protection in the form of gold as well. We have a gold bullion product that can be used. And lastly, what I want to emphasize is that some products are somewhat or security would tend to do extremely well in an inflationary environment. A few examples I can give you are some hybrid type of security. Preferred shares, for instance, tend to do well in that environment, but just credit. Look at the leverage loan, for instance, market is a market where when inflation is picking up for good reasons, you will see that companies are healthy, and typically you can get return that would offset some part of that inflation picking up.
Wonderful. Thanks, Hadiza. The next question, I'm gonna give it to you, Gary. So this is coming from Heather. IGM is the largest. Oh, Hadiza, can you mute yourself? Thank you. Awesome. So Heather's asking, IGM is the largest shareholder in Wealthsimple. What attracted us to that business?
Thank you, Heather. So when we look at Wealthsimple, Wealthsimple is a business now. Heather, if you could, Janet, sorry, could you just mute your line? There we go. So Wealthsimple is innovative. It's new to the scene. It's a business that attracts younger generation, do it yourself. So when we think of that business and we think of IGM's traditional business, which was built on IG Wealth, financial advice, and then McKinsey, which is the asset management arm, we tend to get that question a lot is, what did we see there? The one area is that we're always looking at longer term trends and how can we partner and service clients across Canada and offer them the solutions that they want. So Wealthsimple is about financial services. There are wrap programs within for investors that want to take on and have the capacity with the information available to take on that responsibility for themselves. So it's an incredible opportunity when you look at the runway. Another advantage of Wealthsimple, it's bringing in a younger and newer generation to investing. So we don't know what the future looks like, But potentially what may happen when you look at just the different areas of the business is that Wealthsimple gets people invested earlier as they build assets and their situation becomes more complex and they require that financial advice for tax situation or insurance, then they're able to be referred over into IG Wealth or any financial planning where they actually require that advice now to work with. So that was the real attractive nature. Technology has changed the world. It's changing the way consumers interact with every business. And that was the thought process behind looking at Wealthsimple and just seeing how the world is changing. Fun fact, a lot of times when we think of Africa and countries in Africa, we say they're behind. They're not as advanced. Whereas when you look at countries like Kenya, they actually leapfrogged our financial system because most of their banking is done over a telephone now. So they have near-field communications. They just exchange money on phones. So when you start going across the world, and we have people traveling, looking at just different potential solutions. In China, a lot of the money is transferred through WeChat. That brings back a lot of intelligence in terms of what is the potential for these new technologies as we adopt in Canada more cell-based, more digital capabilities. And I think that's where we found the opportunity with Wealthsimple. Incredible investment. I don't think every investment works out like Wealthsimple, but we'll take it whenever they do.
Awesome. Thank you so much, Gary. Another question here. Can one of the panelists speak to yield generation in relation to sustainable investing?
I can go first, and then I can maybe pass something off to Hadiza because she has much more fixed income knowledge than I do. But it's a great question, and I'm really impressed by all the questions, folks. So keep them coming. One of the things that is probably important to highlight is that there's a thing called the greenium in green bonds specifically. So what that is like it's the ability of issuers to achieve more favorable or reduced cost of funding by issuing debt that specifies the use of proceeds. That's how green bonds work. In theory, what that would mean is that investors would have to accept a lower potential yield than if the company issued a traditional bond. So that is viewed as the premium to invest in green bonds, for one example. And that's where the greenium term comes from. However, and as Hadiza will probably add as well, we detractors from this opinion, or people who don't necessarily agree with that opinion, we think that green bonds tend to demonstrate less drawdown than traditional bonds. They also tend to be held much longer, and there's less turnover. So because investors want to see where that bond is going to go, where the use of proceeds, how it's going to develop. So they can vary by credit rating, sector, region. There's all these things that go into them as well. And so that also lends itself to an active approach. So to not just go with a passive approach. So we would argue in the long term, while there may be a 5 to 10 basis point difference for some green bonds right now, we think that that's going to even out over time. And we think that those sustainable fixed income is actually a great place to invest. Hadiza, would you add to that? I'll go on mute.
It's a great answer, Barris. And I think the only thing I would add is, from a risk-adjusted perspective, if you look over a full market cycle, including the drawdown that you mentioned and that upside phase, typically green bonds or ESG label debt tend to outperform traditional bonds. So that is one perspective. And the second perspective is, to your point, they tend to be held to maturity. So when there is volatility in the market, they tend to hold up really extremely better than typical traditional bond. And the last thing I want to highlight is the ESG label debt is expanding. Traditionally, you would see government, supranational agency were the first adopter of ESG label debt, then large corporate, and now you're seeing more and more high yield leverage loan type of issuer who tends to offer wider spread coming into that market. So when you look maybe a few years from now, you will see the average index of a sustainable bond in universe a bit higher than you can see today. So there is prospect. And again, the risk-adjusted return is really compelling in the space.
Wonderful. Thank you. So I think we have time for one last question, but if there's still more questions, Barris and Hadiza will be available in one of the breakout rooms. So please feel free to join them there to carry on the discussion. But for the last discussion point here, for a new investor, what would the best investment advice you could give in terms of where to start in this current environment? And kind of like in addition to that, I see a couple of questions around, okay, mutual funds, ETFs, what's the future? Are ETFs taking away a lot of market share? So maybe we can just kind of combine that question and throw it out to the panel.
Maybe I'll just take a swipe at it. I think it kind of leads back to where I was trying to go, that, not only the investment universe, but investment products are very complex. That's not necessarily complex, but there's a vast array of them, and you just mentioned a number of them. So understanding, what are my investable options, and how to go about constructing that portfolio based on my goals, objectives, and my risk tolerance is very, very challenging. So it all comes back, at least in my opinion, it comes back to getting help, the value of advice. And, the value of advice, I think I mentioned this earlier, that there's a lot of studies out there that show empirically that those who have advice, that their investment experience over time adds a tremendous amount of value to those against those who don't. And that's part of it. The complexity of the products, the complexity of the markets, the volatility of the markets, it all comes together, and it can be extremely overwhelming to an individual, particularly someone who's starting out, who wants to, start participating in some type of exposure to the capital market. So my answer is advice is critical to anybody, particularly those who are starting out, to get good advice at the front end, so you don't make a whole bunch of mistakes and then go out to find advice that tells you why you made all those mistakes.
And Bill, I'll just jump in just on the mutual fund inefficiency. The first thing you have to, I would say, I would highlight is vehicles are just wrappers to get an underlying investment. So a lot of times we get pulled into mutual fund versus ETF versus closed end versus an OM private structure. There's benefits to each structure depending on what you want to accomplish, how much money you have to invest. So I would not, and at Mackenzie specifically, we are agnostic. We have a mutual fund business, we have a full ETF business, and we have liquid and private alternatives. So we're agnostic in terms of the structure, but what we've realized in having discussions with institutions, when I was on the institutional side, or advisors, it comes down to how do you want to allocate your risk and how are you constructing your portfolio? And based on those metrics, sometimes they'll use fee budgeting, so they'll want a lower cost passive index. Sometimes they're looking for more active management, which tended to lend itself better towards a mutual fund. And then sometimes they want illiquid asset classes that just cannot be wrapped in a mutual fund or an ETF at this current time because you need the liquidity. So one of the areas with ETFs that we always need to be mindful of is ETFs are instant liquidity. You're trading constantly. You can't have a capacity constrained EM small cap active strategy in an ETF. You need to be able to control the flows. So I would say each structure has its purpose. The question becomes, what investment do you want in each structure to optimize your return?
Wonderful. Great answer. So I think we're at time now. We're at 6 o'clock. So this is the portion where we will be moving into our breakout rooms for networking. So I see that there's still some questions coming in, so I would really encourage you to join the breakout room with Barris and Hadiza. If you have some further questions, they'd be happy to answer. Thank you to Barris, Gary, Hadiza, and Bill for joining us today. This was a great session. And if the COFP team wouldn't mind providing the instructions in terms of how everyone can join the different breakout rooms, as I don't have those.
Hello, everyone. Okay, so for the breakout room, what you would do on your screen, so not the panelist here, you're gonna need whomever wants to join. There's a different link that you will need to use to join on. However, for the audience, if you look to the left of your screen, there is a little bubble that shows, I think, 3 people and a table. That's the session. Once you hit on that, on the left of your screen, it will take you to the respective breakout areas, okay? All right, Janice. So I'm gonna move over now we can move over to that stage.
Sure. Could you remind Barris, Hadiza, and I in the private chat the link for their particular room? That'd be great. Okay. Thanks so much.
Janet, I'll be in the breakout also.
Oh, awesome, Gary. Thanks for staying.
Okay. All right.
I'm sorry, I've got a previous commitment, so I have to hop. Thanks very much, everybody. Thanks for having me.
Take care, Bill. Great job. Thank you.
So long.
All right.